talk for a few minutes about a sales tax. We know that in the United States, local governments, occasionally state governments, pretty universally, impose sales taxes on you and I when we purchase certain goods. In the United States, we don't have a federal sales tax as such, at least not yet, but it's common practice in many other countries, particularly in Europe. They use what they call a value-added tax, VAT, and it's in effect a national sales tax. There has been a movement in the United States to move away from our income tax system and stop taxing income and instead impose a national sales tax on products and services. And the argument behind that is, why would we want to tax people for earning money? That's like penalizing them for earning money. Why don't we instead tax them when they spend the money? That way, if you want to go out and earn a lot of money and save it, you don't have to pay any taxes on it until you spend it. That's more incentive to work. Now, there are a number of arguments against that. One, very quickly, the national sales tax. What happens to sales when an economy goes into a recession? Sales fall, and as a result, sales tax collections fall. And they tend to fall more dramatically than incomes and income taxes. So the income tax is viewed to be a more stable, more predictable source of revenue for the government. That's just one of the many arguments that goes back and forth about should we move towards a sales tax or a consumption tax rather than an income tax. But let's talk about a sales tax for just a minute. A sales tax is generally regarded to be, at least on the surface, a regressive tax. That is, it tends to penalize low-income earners more than it does high-income earners, and here's why. All right, we're going to look at two families, A and B. Okay, just husband and wife, let's say. And in family A, they make a total, and simple numbers here, they make $30,000 in income. Okay? Family B makes $100,000 in income. Let's let them both pay a 6% sales tax on their spending now. Well, how much does this family spend? And the answer is, in the United States these days, they probably spend just about all of that money. They don't have a lot of slack in their saving money. So we're going to assume they can't afford to save money. And so they spend it all, and so their taxes are 6% of that amount. So they pay $1,800 in taxes. And their tax rate now is $1,800, their average tax rate, over the $30,000 is, in fact, yes, the 6%. Okay? That's pretty straightforward. Let's look at family B over here with $100,000. How much can they save? Let's say, for grins, they're going to save $30,000 a year. Savings. And so they only spend $70,000, and they therefore only pay the tax on the money they spend. So they pay $4,200 in taxes. Okay? Yes, they pay more than this family, but what's their average tax rate? Their average tax rate is the taxes they pay divided by their income. $100,000. So they're paying 4.2% compared to the lower income family that's paying 6% of their income, because these folks are not making enough money to save. And you know the numbers are somewhat extreme to illustrate the point, but the fact remains, as long as you are making enough money to save some of it and not spend it, and when you don't spend it, you don't pay tax on it. And so your effective tax rate is lower than it is for this low-income family. This is a regressive tax. So we say the sales tax is regressive. We eliminate a lot of that regressivity in the United States, each state having its own rules. For example, we may not apply the sales tax to certain necessary purchases in life, like food or medicine, and to the extent that each family doesn't pay a tax on that, that eases the burden more for the low-income family than it does for the high-income family. And so it takes some of the regressivity of the tax out, but it doesn't eliminate it. All right? One other comment about this tax, or not really so much a sales tax, but let's look at the idea of a flat tax. Let's impose a 10% income tax now. I'm going to change into income taxes. A 10% income tax on each family right now. This family would pay $3,000. This family would pay $10,000. And you can argue that's fair or not fair. That's up to you. We'll debate that in class or wherever. But look what happens over time. Assuming both families are growing, that is, their incomes are growing, they're working longer in their job, they're getting better, making more money. Let's give each family a 10% income increase. Okay? So now, different color here. Now this family's making $110,000. They're paying $11,000 in taxes. You with me? 10% of $110,000. This family's now making $33,000, and so they're paying $3,300 in taxes, and it seems kind of okay, right? But look at the difference in their after-tax income. Originally, the difference in their incomes, after taxes, $30,000 minus $3,000, they had a $27,000 after-tax income. After tax. These folks, 100 minus 10, they had a $90,000 after-tax income, okay? That's before they both got a 10% pay increase. Now that they've got this 10% pay increase, what's going on? What's the difference in their after-tax income? Well, their after-tax income now, after the pay increase, 110 minus 11, they're bringing home $99,000. 33,000 minus 3,300 would be what? 29,700? Does that sound right? Yep, okay. Now, what's happened? What's happened here? The difference in their after-tax income originally was what? $63,000? You see that? The difference between their after-tax income, $63,000, and now the difference in their after-tax income is what? That's high math, isn't it? There's a 300 in there. That's an 18 would be 9. That's an 8 would be $69,300. Does that seem right? Yeah, I think that's right, okay? So what's happened? Over time, as both families prospered equally, both growing their income by 10%, the discrepancy or the difference in their earnings has grown wider. And over time, that would continue to happen. And so one of the arguments against the flat tax is that it contributes to a growing disparity of income between the low incomes and the high income. And then you add to that the idea, who's more likely to see a 10% increase in their pay? And most folks say, well, probably these folks over here. They probably are better educated, working in a better environment with more potential, okay? And so this problem becomes even more aggravated. These are some of the ins and outs about taxes and tax systems, and you need to be kind of versed in some of this stuff to talk about it intelligently and not talk about it in terms of 5-second sound bites off the news, okay? And you better be ready to talk about it on an exam. Thank you.